Hello, everyone. I'd like to welcome you to the broadcast. We're just going to give people a couple more minutes to come in case they're a little bit late. So just wait 2 minutes and please be patient. Appreciate it. All right, Michael, would you like to go ahead and get started?
Let's start.
Okay, so hello, everyone. My name is Dylan Pollock at National Mortgage Professional Magazine, and I would like to welcome you to our webinar titled Small Balance Commercial Mortgages, Jumpstart Your Business in 2016, sponsored and presented by Silverhill. I'd like to thank all of our webinar attendees for taking the time out of their busy days for this valuable and informative webinar and our ongoing series of webinars. So today's webinar will be conducted by Michael Baggiano, National Sales Manager at Silverhill. Mike is the Head of Production for Small Balance Commercial Loan Originations at Silverhill Funding. He has over 25 years of industry experience, including more than a decade at Bayview as a senior executive in various leadership positions. Among Mike's notable accomplishments is playing a key role in the successful 2003 launch of Silverhill Financial, followed by growing the sales team and originations. His team closed 35,000 loans with $10 billion in overall principal balance. He has also negotiated and purchased commercial loans from a variety of financial institutions. We will try to answer as many questions as possible at the end of the webinar. Now, without any further ado, I'd like to turn things over to Michael Baggiano.
Dylan, thank you. I appreciate that introduction. And again, everybody, thank you for taking time out of your busy days. I know we all have transactions that we're trying to close up prior to the end of the month, so let's get started. Small balance commercial, the opportunity is out there. Numerous publications have presented that in separate articles, the opportunities that are presented by offering small balance commercial products to your clients. It's an exciting time of the business to be in it as we are gaining traction in this marketplace. Okay. Today's objectives, even though we're going to cover a lot of material in a small amount of time, we're going to be able to hit on a lot of the key points in commercial lending that will give you a good understanding on how to expand on your business. So we're going to understand the opportunity with small balance commercial. We're going to differentiate between residential and commercial markets, understand the borrowers and their motivations, understand commercial qualifiers that affect rates and terms, understand providing solution to your commercial borrowers, learn how to get started with small balance commercial.
All right, Michael, I believe we have a poll question now for the attendees. All right, so everybody, we'd like to ask, are you actively pursuing small balance commercial mortgage loans today? So I'm going to give everybody about 30 or 40 seconds to vote on this one, and then we'll share the results. All right, so we're going to close that up now. So the results of the poll, we had 43% said yes, they are pursuing small balance commercial mortgage loans today, and 57% said no.
Almost pretty even distribution. Fantastic. Okay, well, we'll discuss for the folks who are not pursuing commercial originations or haven't offered commercial originations in the past. We're just going to highlight some of the key differences between the two. Residential tends to be a very standardized process in terms of properties and forms. Many comparables are available in the marketplace. Simple appraisals, typically desktop, lower costs, no more than $1,000 for the most part. Extensive LTVs, and what I mean by that is that you can fully leverage a property up to about 97% financing. Borrowers are qualified based on their income and DTI ratio. One of the big differences between residential and commercial is the extensive compliances and regulatory oversight that has crept into the business over the prior few years. On the commercial side, deals tend to be non-standardized. No two deals are exactly the same. Doesn't matter if you have two 6-unit apartment buildings side by side. There are differences in between the leases and the property operations that make them two unique transactions. Commercial properties are not as abundant in the marketplace and thus limited comparables. The appraisals tend to be more complex and expensive. Typically, there's 3 approaches to value that's performed by an appraiser for a commercial property. Cost for appraisals on small balance commercial seen run between $1,500 and $5,000 depending upon the property type, location, and the complexity of the transaction. On larger balance commercial deals, I've done appraisals that have cost upwards of $25,000. It's probably one of the biggest differences between the two programs. Limited LTVs, the SBA will provide probably the greatest leverage out there, up to 90%. On the 504 and 7A programs, but normally commercial lenders are between 70 and 75% on their leverage. Another difference is the property or the borrower's business occupying that property has to have the ability to cover the debt or service the debt. And again, in commercial, there's a limited government oversight. We have no TRID. There's only approximately 12 states that have some sort of licensing requirements. 6 of the 12 have exemptions where you can broker commercial loans without a license. Again, to hit on some more of the key differences between residential and commercial. Residential is strictly rate driven. You've seen this recently, a slight uptick in rates will have a tremendous impact on your refinancing activities, especially with larger loans. Residential tends to be a commoditized product. No difference in it's a Fannie Freddie offered product. There's not much difference between what lenders can offer. You have competition from not only from the banks but from other lenders in the marketplace. Again, borrower's income is what's utilized to qualify a borrower for the residential financing, and again, standard appraisals. Commercial tends to be solution-based. What is the borrower attempting to solve? It's not only about rate and term or purchase. They might have other factors that they're trying to accomplish with their transaction. Indirect competition. There's less competition in the marketplace in terms of banks and other lenders. The property's income or the business income is what's used to utilize to support the borrower's ability to support the debt. And then specialized appraisals. Depending on the property type, owner-occupied versus investment, you will have different approaches to value and different ways of lenders looking to value the property.
Michael, I believe we have another poll question for the attendees.
All right.
So this question is, why would you potentially pass on a small balance commercial mortgage deal? Is it A, you're focused on residential business, B, you're not familiar with the needs of commercial clients, C, it's too complex, D, it's too time-consuming, or E, it's intimidating? So we're going to give another 20 seconds to answer that one. All right, we're going to close that poll up now and share the results with you. So 38% said they were not familiar with the needs of commercial clients, and 24% said they were focused on residential business. And then below that, you had 14% for too complex or too time-consuming, and only 10% for intimidating.
Okay. Okay, so to continue with some of the similarities between commercial and residential, vocabulary is pretty much the same. You know, both programs have fixed rates, adjustable rate mortgages, balloons, interest-only options. You use LTVs. A lot of commercial lenders do have recourse on their transactions. Terms or amortizations, 15, 20, or 30 years. Again, either fully amortizing or balloon payments. Options, you know, our borrowers do have the ability to buy down the rate. You have fixed rates and adjustable. Buy-up is yield spread premium. Here at Silver Hill Funding, we do allow a point of yield spread into the transaction. The requirements, basically the same. I mean, both residential and commercial will utilize loan applications. We're going to look at the credit history on the commercial side as you do on the residential side. Both programs require appraisals, and both programs require documentation. Some lenders more so than others, but documentation is going to be needed for the lender's ability to underwrite the transaction. Differences between the programs, you have prepayment penalties and some terms. You have debt yield out there, defeasance and yield maintenance. That's probably new terminology if you're not in the commercial arena. All that is just different prepayment options. Commercial lenders are going to look to the property's net operating income. We're going to utilize a rent roll, income statement, and cap rates in order to determine the underwriting on the transaction. Small balance opportunity, commercial opportunity. Simple. The market is large and underserved. There's an estimated 14.3 million small business properties in the U.S. They're in constant need for financing. What does that mean? Is that the majority of these loans are not fully amortizing. They're balloons, either on 5, 7, or 10-year terms, and they consistently roll. So you can do a transaction with one borrower and have multiple opportunities as that loan rolls every 5 or 7 or 10 years. Borrowers find it a struggle to secure financing on their own. Why? A recent study showed that almost 80% of small business owners that are applying with banks are rejected for various reasons, and we'll cover that a little bit later on in the discussion. But for the most part, the small balance commercial landscape for lenders is fragmented. You only have a handful of national lenders out there outside of the SBA or the agencies that provide national landscaping, national financing. And because of that, there's a lack of standardization and predictability in terms of understanding each of the lenders' underwriting guidelines. This provides an opportunity for brokers to use their expertise in developing relationships with lenders to serve their borrowers in securing financing. Next slide basically defines how lenders are identified in the marketplace. Micro-commercial is a relatively new term. It's a sub $1 million lender. Silver Hill Funding is a micro small balance commercial lender. We provide financing from $250,000 to $1 million. Small balance commercial lenders, this is probably the more traditional definition of a small balance commercial lender, $1 million to $5 million. You'll find life companies, conduits, agencies, and banks operating in this space. Large or jumbo commercial, much more competitive. You have banks, life companies, conduits again. And then it's further broken down by the type of underwriting they provide within these organizations. You have no doc, low doc, full doc programs. For example, a low doc program might be just a stated income on the property. And we just had a borrower who purchased the property of April of 2015. Purchased the property. It was a 12-unit multifamily. Purchased it for $500,000. It was underperforming. It was 50% occupied at the time of the purchase. They dropped in at $250,000 of improvements over a 2 to 3 month period, restabilized the property by re-tenanting it to 90% occupancy. It took them 6 months from date of acquisition to stabilization. But when you look at the tax returns for 2015, none of that's going to be, the income's not going to be reflective in their tax returns. So we have a stated income program where we'll look to the operating statement of the property plus the current rent roll in order to determine that property's ability to service the debt from an income perspective. So I always hear this. I would do, and both on the residential side and the commercial, from commercial brokers, I would do more commercial deals if I could find a lender I could depend on. I hear this all the time. I mean, mortgage brokers being, if you're residential or commercial, you're looking for a lender that has consistency in their guidelines. Not that every time the wind shifts, their guidelines shift, and it's a different set of rules for every transaction. You know, I also hear that it depends on a lender that's going to walk me through their process. Being a novice or somebody who's done this in the past, each lender has different underwriting guidelines. So a lender that's willing to educate both the residential and the commercial broker on their underwriting guidelines. And you also want a lender that values your relationships as much as you do, because I understand that is your lifeblood of your business.
All right, Michael, now we had another poll question for the attendees. So we wanted to ask everybody, would you consider working in commercial if there was a lender that would help you? And it's just a yes or no question, so we'll give everybody 20, 25 seconds to answer this one. All right, so I'm going to close this one down now. So this one's a little lopsided. We had 100% say yes, that they would consider working commercial if there was a lender to help them.
Fantastic. So commercial is good for business. It gives you an opportunity to strengthen client relationships and reputation. You become a true mortgage professional by being able to service all of your clients' needs, both on the residential and commercial aspects. Diversification and new revenue streams and change in markets. Listen, we all understand the interest rate environment that we're in, it's going up. From what certain studies I've seen, it's projecting that interest rates are going to move as much as 300 basis points over the next 3 years. What does that mean to your refinance business, and how are you going to replace that revenue stream that you've had over the past several years while we operated in this lower interest rate environment? Sure, you're still going to have your purchase business, but you're going to need to replace that revenue stream with another product line. Less competition in the commercial mortgage origination business, far less brokers than in the commercial arena than in the residential. Less interest rate driven. The value that we offer to our clients goes far beyond the rate. You know, not at all times. The lowest rate does not necessarily mean the best rate for your borrower. One relationship, multiple transaction opportunities. You know, you can have a client that has a residential, he's purchasing a residential property, and you go through his 1003 and you see that he has a commercial property. It gives you an opportunity to earn, off of one relationship multiple times. And again, as we stated earlier, commercial loans tend to have ballooned out, so you have an opportunity to refinance this borrower, multiple times during the duration of their ownership of that property. Few disclosure requirements, we touched on that. We touched on the TRID comp. There's no TRID complications. It's fun. Why is it fun? Because you're doing something different. To me, small balance commercial provides you an opportunity to grow your customer and your business base. Okay, so getting started. How do I get started with this? I'm interested, but how do I find the leads in terms of getting started in commercial lending? You already have, believe it or not, you have existing clients that have commercial borrowing needs. Again, check your borrowers 1003s, small business owners, self-employed borrowers. These folks tend to own their own business, be it a florist, be it a bar, a restaurant, plumber, or electrician, even on the professionals with their own practices, doctors, accountants, architects, attorneys. I'm sure you finance these folks. Look at their 1003 and see what their REO schedule looks like, and rest assured they own commercial properties. Self-employed individuals, if they're professionals, they might be renting now, but lo and behold, sometime in the future, they might want to buy their own building to house their practice. These are the first-time investors. Look at your borrowers, 1003, see what their REO schedule is, and see if they have existing properties. You can leverage your existing referral network for commercial leads. The same folks that you go to for your residential business, I'm sure these same folks are doing commercial. Title companies, law firms, insurance companies, real estate agents, CPAs, and we should put banks up top because they're the best source for referrals on bank turndowns. Again, if over 80% of banks, if small business owners can't get financing at banks, what a referral stream that you can get from them. Borrowers and motivations. Not too different than what you see on the residential side. Why are borrowers seeking financing? Purchase either to house their existing business or maybe even expand on their existing business. Might be an investment opportunity. Rate and term. In a declining interest rate environment, your commercial borrowers are no different than your residential borrowers that are looking to take advantage of a lower interest rate for an extended period of time. Might have a balloon payment coming due. Again, these are term loans, so they are going to balloon out after a certain period of time, and they have no choice. Either to refinance or they're going to have to sell the property. And then cash out refinance is a couple of different scenarios here. One I see a lot is expansion. Either they want to add additional staff, inventory, perhaps open up a second location. If that's the case, you get two transactions there for the price of one. You get to refinance them, and you get to finance them on their acquisition. And then the other opportunities are repair or remodel of their existing properties. And then they might have an investment opportunity that they want to take part of their equity out of their existing property and invest in another property. And the reason, implications of the motives, lenders have different limits on what they're willing to finance. And some lenders do specialize on different property types and scenarios. We mentioned before that almost 80% of small balance commercial lenders, of small commercial borrowers, are turned down by conventional lenders. And these are some of the reasons. Most community banks operate within a certain geographic footprint, and they're not comfortable when they get outside of it. So that's one of the reasons. Lenders do have legal lending limits on an individual borrower or their exposure to a property type. The collateral might be acceptable, property use or condition. What I see a lot in the marketplace is cash out refinancing. A lot of lenders will put limits on the amount of cash out. Here at Silver Hill, we do not have any limitations on cash out refinancing. Actually, the only limitation we have is the property's ability to service the debt. Debt service coverage ratio does not meet the lender's standards. You have different requirements on different property types. Typically, it's 1.2 on multifamily, and we'll get into how DSCR is calculated later on. But the higher the debt service coverage ratio requirements, basically the less that can be loaned. And then you also, the borrower might be seeking higher LTV. Other reasons include seasoning on the property, insufficient documentation that the borrower can provide to the lender for the financing. here are some other reasons why borrowers seek financing options in the marketplace. Time to close, banks, the SBA. Actually, the SBA has gotten a little bit better, but you can see that when you go to a bank, they're going to take 60 to 90 days to close on the transaction. Balloon notes, they're looking for some fully, it's 5 or 7, 10 years on the balloons. They're looking for a lender that can offer fully amortizing loans. Certain lenders will require cross-collateralization, including the equity in a borrower's house, to secure the first lien position on the property. Upfront fees, continuing reporting requirements. Certain lenders will require annual tax returns, financial statements, credit reports. For a small business owner who's focused on driving their own business, becoming an accountant and providing financial documentation to the bank, it's just another burden on them. And then you have restricted covenants in terms of what the property can do, or if it falls below a certain occupancy requirement or debt service coverage ratio, they can be called in technical default on that loan. I mean, here at Silver Hill, we have a philosophy. It's basically we allow borrowers to operate their business. We don't have any ongoing reporting requirements. Again, we allow the borrowers to focus in what their investment is in the real estate, as opposed to being a document manager. So now you know why borrowers have been turned down. I always think the most important aspect of the transaction is how you open a transaction, because it will depend on how you close the deal. So first thing that you need to do is get to know your borrower. Ask as many questions, listen, and take notes. Look for what the story is on the transaction in terms of the property type. Property type is not just commercial. There's different types of properties. The motive. Why are they? This is the most important question. Why are they seeking financing? As I said before, the lowest rate might not be the best solution if it doesn't achieve their goals. Loan amount, need to know, that's an obvious, right? How much money they're seeking. But on top of that, what's the value of the property, so you can determine what the leverage that they're seeking on that transaction. And then desired term and options. Ask this question just to make sure it backs into the motive. If somebody is looking to cash out and have a short hold period on the transaction, say for 2 or 3 years, that rate is not going to be the lowest rate that they can achieve in the marketplace. And they're looking for, and on top of that, they're looking for flexible prepayment penalties. It's more of a bridge loan, and they're looking for flexibility in their financing. And if you give them a fixed rate with a prepayment penalty on a permanent loan, it doesn't achieve their goals. And other things that you have to look for, which will impact the pricing of a transaction, is their ability to provide documentation. Twofold, if it's no doc or low doc, the pricing will be higher for those types of transactions. But more importantly, you want to see how they are organized from a borrower's perspective, because if they're tight on their documents, on their financials, it kind of gives you a good indication on how a transaction is going to proceed forward. If they're sloppy or the financials are incomplete, it also kind of gives you an indication on what kind of transaction that lies in front of you. And the credit history, the better the credit scores, the better the pricing. The lower the credit scores, the less leverage that lenders will provide, and it's going to be a more costly loan for that borrower. Commercial qualifiers. I mean, you guys drive past these property types every day. Multifamily and mixed use are probably the most prevalent properties in the marketplace. They tend to get the best pricing and the highest leverage. The commercial properties here, retail, office, warehouse, light industrial, and self-storage, are just the notch below the multifamily and mixed use. And below that, you have other properties or special purpose properties such as hotels, restaurants, bars, marinas, golf courses. These are more difficult to finance. Typically, because they are special purpose and you're valuing the business as opposed to just valuing the real estate. These tend to have the lower leverage and have higher pricing because of the more difficulty in valuing these properties. When you look at a property to qualify for a commercial transaction, the use of the property, as I stated before, it's just not that it's commercial. Understand what the property is being used for. If it's a mixed use, how is it mixed use? Is it 10 units over 2 commercial, be it a restaurant and a bar? Is it 10 units over a dry cleaning plant? I've seen a mixed use where it's over an automotive repair. Those all have different implications to them. So you just have to ask the question. You have to also know if it's owner-occupied versus investment, because that's going to also impact the lender's underwriting. Location is important. Always get the property address, including the city and state. Zoning of the property, you need to understand if it's conforming or non-conforming. We've seen single families being operated as commercial properties, which even though it has a shingle outside of it, if it's zoned residential, it is a residential property, and commercial lenders will not lend on that property type. Occupancy, how well occupied is it? If it's 50% or less, got to ask the question, why is it? Because there's something wrong with in a market that has an occupancies that average 80%, 90%, and the subject property is 50%. You have to ask that question. And then leases or financial information, you need to obtain these in rent roll, income statements. Most lenders are going to ask for 2 years of operating statements and tax returns and a year-to-date operating statement. Capital improvement schedules. Those are, the scenario I gave you earlier on where a borrower purchased an underperforming property and invests $250,000 in capital improvements. A lender would like to know how the borrower enhanced the value of that property. So, if you don't have access to these documents, you can go out to the Silver Hill Funding website. We have all these documents available that you can easily download. Again, more questions you ask of a borrower about a property, the better off you are. You eliminate the surprises, both from a lender's perspective, your perspective, and a borrower's perspective down the road. You should always visit the property. Visiting the property gives you a good indication of the pride of ownership that your borrower has within the property. Property that's well maintained, that has no deferred maintenance. That borrower probably has his financial statements in order. You go to a property and you see, litter, you see it's not well maintained. I can rest assured that's the same borrower whose financials are in a disarray. It kind of gives you an indication on what kind of transaction you're going to have with that borrower. Get pictures. Pictures are important. I mean, every lender will require pictures of the property. There's a saying that if a picture's worth 1,000 words, 1,000 pictures are worth 1,000,000 words. They don't need 1,000 pictures. As a lender, what they like to see is pictures of the interior, the exterior, and some neighborhood shots. If you can't get out to the neighborhood, Google Earth the property, and you can get a good indication of what the condition of the neighborhood is. I've seen pictures of properties that are immaculate. You scan back away from the property, and you have board-ups, you have buildings that are derelict. The property is an oasis in a very economically challenged area. You're probably going to have some valuation concerns with that property based on the market. And then you look for, again, when you go out to properties, look for deferred maintenance or recent improvements. Document the recent improvements, because that's going to give the borrower some additional value that the lender will give credit to. And then again, see what's going on in the neighborhood. Is the neighborhood in decline, or is it being redeveloped? Just understand where the property sits in the marketplace. Realistic values, no different than residential. Most commercial borrowers think that their property is the highest value property in the neighborhood. I always look for listings on comparable properties in the marketplace and call the realtor just to get an indication of what they're offering that property for sale and seeing how it matches up with my borrower's expectations. Environmental concerns, the obvious is, if you have a gas station or a dry cleaner located on site, those are red flags for most lenders. But you have to, again, ask the question. My favorite question is, what were the previous uses of the property? Even though you might have a deli and a restaurant and an office located on the property, you don't know what was at the property previously. And then, environmental screens or environmental reports will find that out. But before you spend your borrower's money and you find that there's an issue on the property, ask them what the property was previously used for, because nobody likes surprises, as I mentioned to you before. And when you do an environmental screen and you find out that what you thought was a clean property has environmental concerns, it's just going to it's going to create a hiccup in your transaction. This is how these methods listed here, how the majority of commercial lenders are going to qualify properties. Debt to income, it's funny, debt to income is primarily used on the residential side. On the commercial side, they flip that to global underwrite. Actually means the same thing. They're underwriting the borrower's ability to support the debt based on their income. On the DTI on the individual, global income based on the business, and the borrower's other revenue streams on the commercial side. Debt service is your mortgage payment. NOI is the net operating income of the property. Simply stated, it's the gross revenues of the property less the operating expenses will give you net operating income. That's the excess cash available to service the debt service. And the calculation of your debt service coverage ratio is your net operating income divided by your debt service. The higher the ratio, the stronger the property. Most lenders on multifamilies will use a 1.2 times debt service coverage ratio. That means that for every $1.20 in net operating income, the property can support $1 in debt. And then the capitalization rate is basically no more than your income divided by the value of the property. So if you have $100,000 in net operating income and your property is worth $1 million, your cap rate is 10%. Who are the lenders in the marketplace? We touched on this lightly, but the larger banks, the money center banks, the B of A's, the Chase Manhattans, JP Morgans, Wells Fargo's, they all operate commercial mortgage origination programs. Smaller banks or your community banks, they're the ones that have the smaller footprints, but tend to cater more to the small balance commercial borrowers. Mortgage bankers or non-bank lenders, there's plenty of those folks out in the marketplace. What defines them as non-bank lenders is that typically they don't have a depository relationship. SBA lenders, agency lenders. Agency lenders are basically Freddie Mac and Fannie Mae. They do have small balance commercial programs on multifamily. Fannie goes from $750 to $5 million. Freddie Mac has a program of $1 million to $5 million. Those are Freddie and Fannie do not underwrite them directly, but they basically utilize a correspondent channel to originate those loans. And then you have hard money and private money folks in the marketplace as well. Okay, lenders types. As you can see on the right, we have broken this out between risk, low, and high. The specialized lenders, be it the SBA or niche lenders such as Fannie and Freddie on their small balance commercial, they tend to offer the highest leverage and the lowest rate. Again, the SBA will go up to 90% financing. There's a government guarantee on a portion of their loans, which allows them to get the leverage and provide lower pricing. And Fannie and Freddie will go up to 80% LTVs on multifamily products. Your traditional here is your typical, it's the most common, it's your banks, your conduits, and your life companies, followed by stated. These tend to be investment bankers, non-bank lenders who have specialized programs. And your hard money is typically your lowest leverage and highest cost, because they can turn a loan around in as little as 5 days. So if you have a borrower that has an investment opportunity, that has a short fuse on it in terms of duration on closing, these hard money guys do serve a purpose, but you're going to pay for it. Their rates are going to be anywhere between 10 and 14%, and I've seen points that they charge 2 to 5. One of the benefits is they don't have prepayment penalties, and they have the ability to execute quickly. Okay, mapping the borrower to a lender. Again, you need to understand your borrower's objectives. You need to have the whole story in the transaction. Know who your lenders are. You need to match you need to match the best lender with your borrower's objectives. Present the borrower's situation. Got to be well organized and a detailed summary of the deal. Your package should include a completed loan application, a summary of the financing that's being requested, both with the pros and cons, strengths and weaknesses of that transaction, the purpose of the financing, the loan amount, and include a financial package, again, a rent roll, income statement, tax returns, pictures, and credit reports. If you want to move to the top of a commercial lender's stack of transactions, have a package that is well organized and well thought out, and I can guarantee you get moved ahead of a package that's either incomplete or sloppy. And then, based on this information, you present the best solution to your borrower. And then, more importantly, you have to provide communication support to and from the borrower. Avoid surprises, both, again, to the lender and for your client. Just make sure everything is communicated clearly, because, again, nobody likes surprises. As a lender, I don't like a surprise. I know a broker doesn't like a surprise. And the last thing that you want to do is surprise your borrower by spending the money and then finding out 3 weeks or 4 weeks into the process that you don't have a transaction. So, next steps, get educated on small balance loan programs. You can read guidelines from the SBA, Fannie or Freddie, even lenders. Most of these are available online. Look for educational offerings from mortgage associations. I've seen the NBA has offered a commercial lending program. It's like 8 courses. It costs $600. It goes over a month. I've seen courses that are charging $60,000 for a 1-week course. I think the best bang for the buck, if you can find the free offerings online from lenders, that's your best bang for the buck. Silver Hill will be offering 8 to 10 minute seminars on commercial lending that will cover financial ratios, financial statements, real estate, and underwriting. And then you have to develop a stable of lenders. One lender is not going to be the end-all to be-all. You should have one local bank, an SBA lender, a non-bank lender, a bridge, an agency lender. The more lenders that you align, different type of lenders that you align yourself with, the better resource you become to your borrower. Market yourself as a small balance commercial advisor. Just tell people, get the word out that you're offering commercial. Getting started, I always recommend apartments. Most of you guys are already doing 1 to 4 units. To make the jump to 5 to 12 is an easy jump, and then once you do a few multifamilies, you can expand out into mixed use and then other commercial properties. We've touched on this before. Review closed and existing loan files. You have clients that you've already done business with. You might not know it, but they're there. Communicate the benefits. Again, just get the word out that you're expanding your business. Explain to your clients the benefit of investing in commercial real estate. Social media, you can go out to LinkedIn. There's LinkedIn. There's Facebook. There's Twitter. There's been many different social media outlets. I've had brokers and borrowers that have found me on LinkedIn, gotten transactions based on that. Join the commercial groups within these organizations. Share content. I do this every single morning. I post an article on my LinkedIn page, and I get activity based on that. If you want to see how to use social media in your business for mortgage brokers, Silver Hill just posted the first of 3 blogs on how commercial mortgage brokers can utilize social media and drive in business. Okay. In summary, the market is large and underserved. We stated it's over 14 million. There's over 14 million small balance commercial properties out there. There's only a limited amount of commercial brokers. Diversification is good for your business. You can do it. Getting started is easy. All you got to do is take that first step. And more importantly, you should find lenders that will support you in developing your small balance commercial. We touched briefly on this. Silver Hill Funding is a small balance commercial lender. Dylan had mentioned that we had closed. We have closed today overall 35,000 loans, $10 billion in finance, and we provide finance between $250 and $1 million on plain vanilla commercial real estate. These are the property types that are eligible: multifamily, mixed-use, warehouse, office, light industrial, self-storage, and retail. We're in the top 200, 250 MSAs. We offer up to 25-year amortization, 70 to 75% LTVs. We do allow for yield spread. Minimum credit score requirements on borrowers is 650. We will have a streamlined program that's going to be rolled out within the next 30 days or so, and it's basically a stated income program on multifamily properties. More to come on that initiative. You can get more information if you like. You can visit our website. It's right here, silverhillfunding.com. I'll give you a complete product description, industry-related blogs, training modules that will be coming soon. You can download a broker registration package, which will give you access to our pricing matrix and an online pricing model, which will be coming out within the next 30 to 60 days as well. We also do have available marketing toolkits that you can use in your business. Basically commercial flyers, email templates that you can utilize in driving your business. And again, we will have all the commercial forms that you will need to underwrite a commercial transaction, including a rent roll, income statement, applications. So that takes us to the conclusion of this webinar. And we're going to open up discussion now to questions. So the first question we have, we do not finance hotels or motels, but we do finance apartments. So the question was, did you say that you do or do not do loans for hotels, motels, and apartments? So the answer there would be, we do finance apartments, but we do not finance hotels or motels. The next question is, how long does the process take? Normally our process is going to take between 30 and 45 days, and we'll move as quickly as the borrower will allow us to move. We've closed the deal in 30 days, and we've closed the deal much further out than 45 days because the borrower didn't cooperate in terms of providing documentation. Next question up, do we do construction loans? No, we only finance stabilized properties. We do not do any renovation loans or construction. Next question, will we finance triplexes? We will not finance any property that has less than 5 units on a residential basis that has less than 5 units. We can finance blanket 2 to 4s, provided that the properties are located in the same geographic area. We prefer that they be contiguous. But we will not finance any single-family residence on our property, on a platform. That's a good question. Typical broker compensation on a transaction. We do allow brokers to charge up to 2 points on the front end, and there is 1 point of yield spread available on the back end, and that costs 37.5 basis points, or 3/8 of a point in rate and margin to earn that 1 point. Credit issues, how do we deal with past lates or bankruptcies? We can entertain borrowers who have some credit, bad credit history in terms of deed in lieu, short sales, foreclosures, even bankruptcies. I think each of those transactions stands on its own. We will entertain it, but we do prefer that any of the borrower's credit issues are behind them on a go-forward basis. They're clean.
Hello, Michael. Are you still there?
We're still here. I guess on licensing, I mean, the best, again, you can go out to the NBA. We don't provide legal advice. If you go out to the NBA, you can pull down the 12 states that have licensing requirements, and the NBA does a great job of listing the exemptions for those states, such as where you can be exempted from licensing. For example, Florida, if you deal with a borrower that's a commercial entity, that's one of the exemptions that you can have. If you deal with a borrower that's an individual, you have to be licensed for the most part. And then last question I have, do you have a submission package template or standard application form we can download? Yes. If you go out to the www.silverhillfunding.com website, under broker forms, you can download all this information.
All right, Michael, I'd like to thank you, and I'd like to thank all the attendees for taking the time to join us on this webinar. And I'd also like to take this time to thank Silverhill for providing us with this excellent content as usual. We look forward to seeing you all. Oh,
Dylan, just one last question. I mean, if you have any additional questions that we didn't answer, you can go out to the website. We have an email address, info@silverhillfunding.com. We'll be more than happy to follow up on these questions.
all right, sorry about that. And thank you, Silverhill and Michael, for providing us with the excellent content. And I'm looking forward to seeing you all on our next webinar. And enjoy the rest of your day.
Thank you.